Just a word or two about my own background before plunging into the deep end. I trained as an accountant many years ago in Glasgow and later founded several companies in the construction and manufacturing industry, both at home and abroad. I was also an early member of the Finance and Taxation Committee of the SNP when it was little more than a political curiosity. The mysterious relationship between money and political power has intrigued me ever since. I grew up in an era of wartime austerity when everybody understood why it was necessary. Thereafter, in the late 50s, we rebuilt the country and enjoyed full employment. We even earned a surplus on our balance of payments. Never repeated, incidentally, since the boom years of Scottish oil. And yet we created the world's first national health service, a decent old age pension, and free education for everybody to the age of 15. All that, and yet the country was stony broke. As so-called liberal economics came to political power, the currency was manipulated, so also cheap imports replaced domestic industry. The paper economy had arrived, and it came to a head in the mid-80s with deregulation, when the national currency ceased to be issued by the Treasury free of debt and became bank credit. When it is issued as debt without democratic accountability, money ceases to be a public asset and becomes a public liability. It becomes a liability not only in the financial sense, as the core of the national debt, but also as a serious disincentive to public investment. This is how public investment has plummeted over the past 50 years, and yet the UK plunges deeper and deeper into debt by the day. We have Wonga at Westminster and are paralysed because we cannot afford to help ourselves. There seems little prospect of change, and so we either stay or we go. If we decide to go, then we must leave this baggage behind and start over. Some experts will of course say it cannot be done, so we must find other experts. The reforms we will describe to you now would enable a sovereign government to exercise the guarantee of the taxpayer directly to fund public investment free from debt or other financial impediment, but subject always to full public accountability under the terms of the Constitution. Apart from the cash in our pockets, all money in circulation is created by our fractional reserve banks. Not everyone is familiar with this process, so please bear with me for a moment. These banks do not re-lend the money deposited with them, but create new credit with every loan and overdraft they make. When a bank makes a loan, it writes the amount into its books as an asset, a sum the borrower owes to the bank. On the other side, it writes a liability, the risk that the loan may default. No one goes without the use of any money during this process. New money is simply created and stokes up inflation. The money supply grows in step with the bank's balance sheets. As an accountant, I can tell you no other concern would get away with this. You may well ask then as to why banks need our savings, even at the derisory rates offered today. Chartered banks may lawfully create credit for their customers, but not directly for their own use. However, your deposit is legally the property of the bank, and this, together with the notorious practice of interbank lending, provides capital for the obscure world of shadow banking and speculation in financial markets. And back in the real world, never forget, as a crippled Greece heads a long list of indebted nations into economic chaos, bank debt can be written off just as easily as legislation permitted banks to create it in the first place. We have grown accustomed to governments being permanently short of money, either demanding more taxation or cutting public services, currently referred to as austerity. We also know that all governments, irrespective of their political stripe, spend far too much time anguishing over money, deficits, borrowing, financial crises, rocketing national debt, and a rogue banking system. Money problems top the agenda, but when did you last hear of any debate challenging the basic system? That's right, never. Yet in every other field of human activity, new ideas displace long-established shibboleth and customs, but not in the age-old money-lending business. That is taboo. Any suggestion of reversing deregulation and returning to a sovereign currency is dismissed as an evil conspiracy to undermine the established order. So perhaps we should take a step back to ponder whether we should continue to fund what is clearly a financial black hole. Might not the problem arise from trying to justify an irrational financial device by bending the rules of bookkeeping and accountancy? Could it possibly be that public investment has nothing whatsoever to do with financial instability? Might we perhaps learn from what happens in the private sector? Financing a business has not changed all that much over the years, and finding working capital via a bank overdraft was usually possible if the collateral security was available. It is the legitimate purpose of bank credit to tide us all over the inevitable gap between paying the wages and receiving payment of our sales invoices. Short-term credit is, and always has been, the purpose of banks. But when it came to capital investment, then we had to look beyond the overdraft. We weren't looking for credit, but for long-term investment with real money, a different kind of money called equity. Long-term real money, the kind of money savers used to invest into building societies where it financed the homes of the next generation. Of course, that was before these mutuals were taken over by the banks. By the way, did you know that until 1986, these mutuals funded 100% of UK mortgages, and that represented 70% of total lending in the UK? Now I ask you to consider the financing of government. It too has everyday running expenses, which have to be found from current taxation. The government also makes long-term investments. Hospitals, schools, road and rail networks. There is a huge list of what we might describe as capital investment within the nation, and that too should have nothing to do with bank credit. In a representative democracy, the people are sovereign. There is no greater manifestation of sovereignty than the national currency. When that money is first authorised by the Treasury and issued by the central bank, it represents the equity of the nation. And that, too, has nothing to do with commercial banks and debt. Conversely, the compounding of national debt is based upon Fox accounting, a manipulation of moneylenders which has become unsustainable. And no amount of privatisation, PFI, austerity, interest rate rigging, inflation or deflation, or fiscal prudence will square this circle. We should perceive the currency as share certificates in our country, which each one of us guarantees as sovereign. I suggest to you that as capital investment is not charged to revenue in the private sector, so also should tangible public investment not be charged against taxation. Now may I ask you to let that heresy stick to the wall for a moment. Monetary policy is mainly about currency and banking. We all use fiat currencies nowadays. Since the 1970s, gold and silver no longer figure in exchanging our goods and services. We have paper tokens, authorised and issued by the state and guaranteed by the taxpayer. The mint produces these at minimal cost and protects them from counterfeiting under the law. In the days of gold and silver, there was a finite quantity of money, and if an individual or government wanted to borrow, then someone else had to go without until the loan was repaid. Fiat currencies may have no intrinsic value whatsoever, but they should be regarded and accounted for in no less rigorous terms. That is simply not possible as long as it remains interchangeable with virtually unlimited bank credit. This anomaly is simply not reconcilable and has defied all attempts to produce rational monetary policy. This is the key issue because, in effect, we struggle with a parallel currency, one unaccountable and issued by private banks on behalf of their shareholders, and the other issued by the state on behalf of the community, and which carries all the responsibility and burdens of public accountability. In the light of this, I ask you to consider how a fiat currency can possibly be interchangeable with ephemeral bank credit. Of course, it is not possible. Only a banker can add apples and oranges and claim they are the same. But politicians, other than half a dozen mavericks, do not wish to know. Before the age of electronic credit, half of all money in circulation was cash like this. The state printed it and sent it to the banks for distribution. It was sovereign money, issued by the people and for the people, and it was their national currency. The state incurred no debt in doing this. When it was delivered to the banks in armoured vans and barrowed into the vaults, the government's account was credited, and it could then draw a cheque on the account and spend the money into circulation on behalf of the community in a process known as seigniorage. Today, only 3 pence in every pound remains as cash. 97% of all money in circulation is now debt owed to some private bank. Yes, that's right. Whilst we were all mesmerised by the convenience of credit, no one noticed that our money was now being issued by the banks in the form of debt. These banks not only lend credit to their customers, but also to governments to fund their national debts. Our money now belonged to the private banks. Money had now been replaced with bank credit, and the public carries the debt. Banking had become a global money-making machine. Just try to imagine if we had retained control over our currency and seigniorage and had updated it to include electronic credit. Instead of delivering debt-free cash to the banks, it would be the national credit, also free of debt, being credited to the government's account. Instead of quantitative easing, funding bailouts, obscure money markets and asset bubbles, it would again enter circulation as government investment. National debt would be capped and progressively written off as bonds matured. The impact of that upon inflation, gainful full employment, modern infrastructure and prosperity would really transform our lives, rich and poor alike. Meantime, we participate in the money game according to the rules of the governing elite. They tell us the money business is safe in their hands. I don't think so. Bankers accuse politicians of being irresponsible when it comes to managing the money system. That may be the pot calling the kettle black, but there is some truth in it. Politicians are probably less financially literate than this audience, but they do listen to public opinion. Unfortunately, special interest groups cannot afford to lobby politicians like big business. We can, however, up our game by joining a think tank which can assemble our ideas into a coherent package, what I call the bigger picture, a policy blueprint appropriate for presentation to an MSP, a petitions committee, or a media story. Innovation and promotion play equally important roles in this process. My colleague Bob Ingram has established the Centre for Scottish Constitutional Studies as a vehicle for progressive ideas within an independent Scotland. The draft constitution includes monetary and fiscal reforms, including those you have just heard. In somewhat more formal language, CSCS describes constitutional money in all its forms, issued free of debt by the state. This entire process would be under the aegis of a constitutional money authority, having a similar status to that of the judiciary, and accountable to very specific clauses in the Constitution. Commercial banks cease to create money ad lib and become full reserve institutions, acting as intermediaries between their customers and the Treasury. From this reinstatement of honest accountancy stems a full reserve banking system wherein savers, pension funds and investors provide the money for bank loans. Any new money over and above this would enter circulation only as payment for a tangible fixed public asset. The national currency is a public good. If it is to remain guaranteed by the taxpayer, then it must be returned to democratic control. Just how this can be engineered in an independent Scotland is set out in a new book entitled Moving On. It ducks no problems and provides the solutions. It informs the key text references in Article 6 of the CSCS Constitution. I think that LVR would also benefit from constitutional reference in broad principle, if not fine detail, and I'm sure Bob would welcome such input. So what is to be done? I do not believe that reform will germinate in Westminster, Washington or Brussels. But it could happen in a small independent nation starting from scratch, provided a workable alternative is carefully crafted and promoted to progressive politicians. That said, the debacle over the currency during the referendum demonstrated that Holyrood, with the exception of the Scottish Greens, failed to perceive the opportunity presented. Still, if the referendum had decided yes, and sterling had remained the currency, then I am sure that within a year there would have been serious thought about an independent currency, and with that would come the opportunity for reform. Thank you for listening.